This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Well, hello and welcome back to Research Talks here with Alan Green and Dan Flynn. So, Alan, how's your week been? How's it been going so far?
Yeah, it's been another quiet one, Mark. I was expecting things to kick off this week, but we've just been ticking over, it seems. But yes, another opportunity to enjoy the fantastic sunshine.
Well, it's incredible, isn't it? Yeah, had a long streak of this very nice warm weather. So, wonder how long it will continue for. But barbecues have been very busy, actually.
They have, yes. Even I took the cover off the barbecue, and we've had a couple already, so it's been really good this week. Yeah,
it's been lovely actually. It's been lovely. And Dan, how was your week been? I know we're recording this a little bit earlier, but what's it been like so far this week?
Yeah, it's been a bit more of a positive week in terms of general news flow on a macro level. I think with the Trump US-China tariff escalation de-escalating somewhat.
Of course, yeah.
Yeah, so it'll be interesting after sort of, reading constantly about how things are getting worse and worse. I don't want to speak to jump the gun too much and, be too positive, but it'll be interesting to see how things play out over the next few weeks. Hopefully we get a bit more of a risk on appetite in the markets.
Well, yeah, maybe. I'm looking at Bitcoin, which of course is a good risk-on, risk-off appetite indicator. It is, of course, over 100,000. It's stayed there for a few days now, but it is down a bit. And in fact, everything seems down. So we've got oil down today and gold down a tiny bit, 0.5%. But yeah, anyway, we'll obviously have to see. But it'd be nice if we get a bit more, stability, or let's say markets like certainty, don't they? So a bit more, confidence in risk on money coming in would of course be very nice. But I mean, speaking of gold, you're going to talk to us about Barton Gold, a company who we've sort of loosely followed at Stockbox for a few years now, having first met them at what was Minds and Money, now Resourcing Tomorrow in London. And Alexander Scanlon always talked a pretty simple game that's sort of really high reward, really. And I met him again at the SMI in March, and they've had a few things happening recently, and they've done a couple of interviews. They've got the all-important optimized scoping study out, sort of revisiting the numbers. There are a lot of cost savings, but I know you've done your research. It's the first sort of time you're going to talk to us about Barton, so let's get your take. We've got a clip to play as well, and then we can go from there.
Yeah, absolutely. Thanks for that, Mark. I was introduced to Barton this week by way of your interview with Alex. We'll hear a bit from that, like you say, in a moment. I thought it was really interesting. But first, I just wanted to quickly give a bit of background of what I see as three very attractive parts of Barton's proposition. So for context, Barton's a gold explorer and developer focused on the world-renowned Gawler Craton in South Australia. And the first thing which immediately struck me about it is that it owns its own fully permitted, sizable gold mill, and it's the only one in the area to boot. As Alex said to you, either in this week's interview or the previous one, this immediately gives it something like a 2 to 3 year and 200 to 300 million head start on any miner that says it wants to be a producer. And that's exactly what Barton wants to be. So the mill is located within its Tarcoola project, and it's surrounded by a number of mineral leases with fully permitted walk-up restart mines that can be almost instantly brought back into production. This includes one called Perseverance, which has around 20,000 ounces of gold on the pit floor and 10,000 ounces in stockpile. So Barton's right now completing analysis for how it plans to reconfigure the mill to get it back online, as well as updating the resources it plans to put through the mill. And why no one else hasn't already done this, I don't know, but Barton plans to have moved into low-cost production by mid-next year, scaling up over the following few years to as much as 50,000 ounces per year production. So this is what it refers to as its stage one operation. And it plans to use the increasing amount of free cash flow it generates from doing so to support the funding of its stage 2 operation. So this centers around another project called Tunkilia, which was the main subject of your interview with Alex, Mark. And it's also the second area that stood out to me. So Tunkilia neighbours Tarcoola, where phase 1's based, but it's a much larger and longer term opportunity. So the project contains a 1.6 million ounce gold resource, which Barton plans to develop with a series of pits. And earlier this month, the company released an optimized scoping study for the project, which estimated average annual production of 120,000 ounces of gold and 250,000 ounces of silver over an 8-year processing period, all-in sustaining costs of roughly 2,200 Aussie dollars an ounce, total life of mine revenues of between 3.9 and 4.8 billion Aussie dollars, and a payback period of under a year. And what's more, all these figures are based on a very conservative gold price of 3,500 Aussie dollars an ounce gold. In Australia, gold's currently trading around $5,000 an ounce. So there's scope for even more upside in those already impressive figures. So finally, and very quickly, the icing on cake for me is, aside from targeting 150,000 ounces a year gold production from those 2 stages I just mentioned, Barton's also made a brand new silver discovery at its Tolma property within the Tarcoola project. I'm aware there's a lot of similar sounding names here, so just to reiterate that Tarcoola is the project where Barton is hoping to start production next year. So Tolma's a lot earlier stage. Barton's still figuring out what it contains. But so far, it's reported a single line of seven discovery holes with 3 silver assays that rank among the highest in the world. That's not an exaggeration. One was 17,600 grams a ton from 46 meters, while the other 2 were over 3,000 grams a ton silver. So Barton's expedited follow-up drilling to find out more about exactly what's there, was stumbled upon at Tolma. And I think it stands to be a company maker in its own right. So I've probably spoken for long enough there now, Mark. Shall we hear a bit about what Alex has to say about what Barton's up to?
Yeah, let's listen to this clip. This is a clip from the interview this week that was about 17 minutes long. So this clip is, summarising some of the key points.
The strategy is start with stage 1, self-fund, and go on to stage 2. And the idea with that combination is that you get that sort of 30,000 ounces per annum going like clockwork at stage 1. And then in Tunkilia, we add 120,000 ounces. So this is where we get to our 150,000 in total. We have just, as you mentioned, published our optimized scoping study last Monday, the 5th of May. And really what this was an optimization, as it is by name. But a very detailed analysis of trade-offs around comminution circuits, efficiencies, power design. We did additional comminution test work. And in short, we were able to confirm a lot of the efficiencies and savings that we expected to achieve following our initial study. We've made material savings in the overall operating cost. We've expanded the resources now to 1.6 million ounces and therefore expanded the pit design. The net result is that we end up with a project that will produce about 1 million ounces of gold and about 2 million ounces of silver across an 8-year period. So 120,000 ounces of gold per annum, 250,000 ounces per annum of silver per annum. And what that yields then at current market prices or slightly below current market prices is about 2.7 billion Australian dollars in operating free cash. And importantly, there's a very strong bias in that free cash towards the front end of the project. So we have this starter pit. We've sort of enhanced or optimized the starter pit as well. We now have about a 5.9 million ton starter pit. So about 1.1 or 1.2 years of operations at the front end that produces over $800 million in gross free cash from about 200,000 ounces of gold and almost 500,000 ounces of silver. So it pays back the project 2 times over in the first 12 or 13 months. This obviously gives it a very strong financing profile when we're talking to our banking partners. We have an existing fully permitted mill and other fully permitted mines. So we can make that transition in 2026 sort of at will, if you will. So thankfully, we aren't reliant upon new environmental approvals for Tunkelia. With Tunkelia, though, your environmental approvals are really your long lead time item. So you have to do 24 months of water studies and 18 months or 2 autumns and 2 spring seasons of flora and fauna studies. So getting that environmental process starts, if you will, that sort of 2-year box of time within which you can do all of the other studies, including feasibility, front-end engineering design, if you'd like. So it's really about getting that going for Tunkelia. Tunkelia, in a manner of speaking, has now come out of theory and has come down into a fairly well-defined development model. And it's just come down and it's gone on this path over here, and now it's moving to commercialization. Now we're bringing stage 1 down in parallel, and that's going to advance. So these will just go side by side now.
There we go. That was good to hear from Alex there. And just to put that 2.7 billion, he said, that's about 1.3 billion pounds, I think, around that. So, significant free cash flow, isn't it, really? And I like that payback in 12 to 18 months with that starter pit. That's very good economics.
Yeah, I didn't mention that starter pit when I was discussing it earlier, but I think that is an important point. That is how this massive project can, actually feasibly reach production in perhaps, a few years. I think that was something Alex spoke about elsewhere in the interview. So I don't know what you think, Mark, but from an investment perspective, I think on paper, Barton appears to be the whole package.
It looks like it, doesn't it? I mean, and Alex is always thinking a lot further ahead. He told me that a long time ago. And again, you can see here, that's exactly what's going on. We'll get into that smaller scale production at 20 to 50,000 ounces initially using their mill. And then but they're already starting the long lead items, as he says, like the environmental studies, which take a long time. It's really nice to see an exploration company really thinking long term, because, well, as we both know, it is a long term game, isn't it? And it's very short term mindset these days. What's next, and things always take longer. But it is a long term game, and I think when you've got a CEO like Alex who can actually articulate that long term vision and long term plan, and you can see that he started things that do take a long time already. In a sense, it doesn't give you as an investor. We all want that kind of instant gratification. What's tomorrow, sort of thing. But with someone like with a company like Barton Gold, I almost feel like I can put my money away, and I know what's going to happen with it. I know how it's going to be used over the next 2 to 3 years to go to that real big project that they've Tunkelia, to get Tunkelia into production. And you almost feel a bit more relaxed. You don't feel perhaps a need to look at the share price every day and think, oh, what's coming next? I don't know about you, but that's actually, I've just kind of had a moment where I just sort of realized that it's probably one of the few CEOs who's actually been able to articulate like a real long-term vision and plan, and is actually actioning it.
Yeah, I absolutely agree. And I really just like the fact that, come mid next year, the company's got a clear way of getting into production that can scale up at low cost. And while it's doing that, it's advancing the longer term opportunity. Like you say, you can just sit on that, can't you, from here? And I think the company itself summed up the potential nicely in its presentation I was looking at, because it highlighted the potential for a re-rate as it moves from explorer to producer status. And I think really that's what I'd be looking out for from here, because you're going to get that re-rate, and then if the company delivers, I think, you don't know what's going to happen at Tunkelia, but let's assume it does go as the company plans, but that production's only going to increase. And company's currently trading, when I looked yesterday, at 143 million Aussie dollars, which is a decent size, but it's not. There's still upside from there if it delivers on its plans, I think.
Exactly. No, exactly. And they're backed by institutions as well, aren't they, who generally have to buy on market, I believe, rather than
That's right.
Get offered placings.
And I had a cash balance of 7 million Aussie dollars as of the end of March. So it's all looking pretty strong.
It is, isn't it? It is, yeah. So again, it's about 50%, isn't it? This exchange rate, roughly speaking. So that 100 million Aussie is 50 million pounds. So for UK investors, 50 million pounds is, it's certainly not micro cap, but it's still small cap, isn't it? Really, I would say at that level.
And you got gold prices that are, we were talking about them falling a little bit up top, but I mean they were extraordinarily high in the midst of the trade tariffs. I think you still can't neglect the fact that I think they've risen by 20% still so far this year. They're still very strong.
Indeed. Well, no, I'm looking forward to that. So I think Alex is at the SMI again this year. So if I do end up going, which I hope to, then we'll see how he's getting on. But thanks, Dan. Thanks for that. Good to get your take on it. So let's talk about the other company I want to cover. It's Igraine, another company that I actually quite like the look of. But go on, take us through it.
Yeah, likewise. So Igraine's really under the radar at the moment. It has a market cap of less than £1 million and volume's pretty low. But after speaking to its CEO, David Levis, with yourself, Mark, on our Musings podcast a month or so back, and after covering the company in a recent newsletter for Stockbox, I think it's adopting a smart strategic approach in a sector that pretty much has to grow, and that could become interesting for early investors. So last year, Igraine shifted its investment strategy onto the UK battery energy sector by securing an exclusive agreement with a company called Gem Energia. Now, before we go into detail on that, just a bit on the macro picture here. So basically, the UK government has set out targets to achieve full power decarbonisation by 2035. It's taking massive strides towards renewable sources like solar and wind power. But while these sources of power are great when it's windy and there's lots of sun, they aren't as good when the weather is calm and grey. These periods are called Dunkelflauts, and you don't need me to tell you, Mark, that they're pretty common in the UK. Mm-hmm. The solution, in theory, is simple. By storing excess wind and solar power when conditions are good, the UK can utilise them when they aren't. But the problem is this requires a massive supply of renewable battery energy storage, and the UK just doesn't have that right now. So the excess solar and wind energy generated in good conditions is simply wasted. And when those Dunkelflauts occur, the UK is forced to either draw in its non-renewable gas storage reserves or import energy, which increases prices and has a detrimental environmental impact. So it means that if the UK government is to meet its goal of decarbonising the energy supply by 2035, it needs to massively increase its renewable battery energy storage capacity to ensure renewable power can be provided consistently. And compounding this even further is the fact that the UK's power demand overall is likely to accelerate enormously over the years ahead. We've got the ongoing mass movement towards electric vehicles and all the charging infrastructure that involves. But also, and this is something David pointed out, the AI data centers that will inevitably become increasingly integral to our day-to-day lives also use huge amounts of power. Some figures I saw said the UK will now need to secure over 200 gigawatts of renewable energy storage capacity before it can retire its last fossil-fueled power station. Right now, its total capacity, including that under construction, sits at just over 5 gigawatts. So as the need to plug that gap becomes increasingly critical, I think the demand for and the value of new sources of renewable energy storage, battery capacity, it's only going to continue to grow. And this is where Igraine comes in. So Gem Energia, the company with whom it's secured an exclusive agreement, identifies and secures the rights over battery storage development sites before managing their progression towards the ready-to-build stage. At this point, it sells the site to an institution to go on and build it. And the profits it reckons it can generate by doing so are enormous. So each site requires some £200,000 of cost outlay to secure the grid connection contracts and offers and necessary permits to reach ready to build. And from there, the expected sale value of a typical 100 megawatt site ranges from £6 million to £12 million post granting of planning permission. So that's a huge potential profit. And what Igraine has secured is the exclusive right of refusal on the investment into all current and future battery storage projects in GEM's portfolio. So I think this gives the company a unique opportunity to benefit from the substantial value appreciation GEM's projects will experience as they advance towards ready to build and are ultimately sold. I think in the future, the pair will look at operating these sites themselves, but for the time being, I think the goal is to sell them. So I think let's just focus on that here. So Igraine's activated a £500,000 facility to provide the initial funds it needs to get its partnership with GEM moving. And the pair are already advancing their first development site in the northwest, with a significant pipeline of other sites ready to go. So, like I said up top, Igraine's currently very under the radar. But as the need for more renewable energy battery storage becomes more urgent and well known, and as more and more investors learn about the potential profit margin of its business model as it releases more updates, I wouldn't be surprised to see it gather a lot more attention. And given how small Igraine is right now, it wouldn't take much to move the needle on its valuation in a very significant way.
Yeah, I agree. And like I say, it's a very simple proposition, isn't it? Just to identify sites, get them effectively ready, and then, as you say, the idea is to sell them on effectively to another party to actually develop it into the battery storage element. But I think it's a great little play on energy. I think investing in energy, whatever it is, whether it's infrastructure or storage, is probably not a bad idea going forward, because we're only going to use more of it, And I know there's always calls, oh dear, we're using how much energy does the mining crypto use? Well, that seems to have gone away for the moment. It's now how much energy does the GPT uses, or the GPUs for the large language models, or the AI. Well, it's not going to slow down. It's only going to become more. We're going to use more and more and more and more and more. So we just need to make sure that we're getting it from renewable places and storing it where we can, like being smarter. So I think we're going to see a massive change in energy infrastructure. You can already see it in the UK. It's happening. I know David Levis went over that in the podcast we did with him a while ago. I think you're going to see small modular nuclear reactors popping up as well, and we're going to have to start, as you say, storing it. So this is a nice little play on that, where you could almost look to take a little position in one of these little energy storage sites, and have it as a sort of a steady income, really. And have a predictable income. It's the sort of thing that, once it's established, it's the sort of thing that pension funds will buy into, because they know what they're going to get return on it. So it's a start of a journey with them, but a good, and they've got the right people in as well with David, I think.
Yeah, he knows what he's doing. Like you say, it's quite a simple business model, but in theory, when you say it like I just did, but I imagine there's a lot of bureaucracy and what permits and things like that, and planning applications alike in the UK. And I think he's the man for the job when it comes to getting these things to the point that they can be sold.
So Mendell Helium, Alan, first of all, lots going on there, and nice to see as well, Nick, in the field.
It's Nick has really done great things with Mendell, and as ever, you look at the share price; it's just ridiculous. The company's currently got a market capitalization of 1.67 million, and of course, the company pivoted away from the old business, which was Voyager Life, struck an agreement to acquire M3 Helium, and this is getting over a year ago, through issuing 57% of its enlarged share capital to make the acquisition. And this is still in the process of completing. The trigger date has been pushed forward to the end of June. So I said trigger date, the completion date will be complete at the end of June. But of course, in the interim, the operating company M3 Helium has been exploring and developing the Hugoton gas field, which is a hugely potent gas field in the center of Kansas. a number of wells, historical wells, and of course wells that are shortly set to come into production. The old business, of course, Voyager Life, was disposed to Orsus Therapeutics. The company continues to own 28% of Orsus and will also receive further upside conditional on Orsus hitting revenue targets. But with the Hugoton gas field, a number of agreements are in place, and the most significant one, I think, is the fact that with the established wells and operations across this incredibly fertile territory, they have an agreement with Scout Energy, who are the owners and operators of the Jayhawk gas processing plant. And they have an exclusive farming agreement over 161,000 acres of Hugoton, which is well known as one of the largest natural gas fields in the USA. And Nick and the team have been over there. Nick was over there recently, working with the team and bringing the Rost well, which is really the flagship well for the asset, back into production. Now, in order to do this, the company, of course, needs to dispose of the water that's extracted from the well in order to release the gas. Now, the Ross well has absolutely huge potential. It was tested in 2022 at 5.1% helium, and it's estimated that once Ross is on stream, it will produce in excess of $100,000 per month, and further upside is also possible on that, of course, based on an improved helium price. But this is hugely significant because most of the other listed helium companies, in fact, all the ones I think that we currently cover and are aware of, aren't at the point where they can move into production within such a near-term time frame. And this is, I think, for the company, it's not only hugely transformational, but of course, for a company to generate that sort of cash just from the one well is hugely exciting and significant. There are, of course, a range of other wells across Hugoton that the company are working with. But if those following Mendell on social helium will have seen on social media will have seen Nick's visits recently to the Rost well and also to the Broby saltwater disposal well, where along with Chief Engineer Alex Chen, Alex was of course appointed back in April, with Chief Engineer Alex Clem, they have together filmed various activities at Roswell and also at the Broby saltwater disposal well. Now, this well was sealed up; it was plugged with concrete plugs and also cast iron plugs. The team are currently in the process of drilling through that and connecting that to the Rost well. So, as the Rost well is drilled and developed, the water can be released from that well and it's pumped straight into the Broby water disposal well. So there are all sorts of possibilities here. With Scout Energy, Mendell are developing a strong relationship. They have agreed a farm-in fee. The farm-in fee that was initially agreed will be paid directly from Ross production proceeds, and this is hugely significant because it'll mean that the $1 million that is required for the farm-in arrangement with Ross, the company won't need to go to the markets to source that externally, and that's a huge step forward. That, of course, has not been reflected in the share price, and my guess is that probably that's the case because the agreement to complete the transaction and complete the acquisition will be completed at the end of June. So I suspect that's probably the reason behind it. So this is Roswell. This is just one well, $100,000 a month. The model that's been agreed going forward will include drilling of a further 25 other wells. And if Scout wishes to use some of Mendell's water disposal wells, Mendell can also levy a water disposal fee to Scout if Scout wishes to use that facility. So huge potential in that regard. There is also a consideration to look at using some of the power that will be generated from this offtake in powering a Bitcoin mining operation. There are all sorts of proposals and possibilities on the table. So I think you often hear in the markets, this company is a great one just to buy and stick away in a drawer. I think we're going to see a lot of near-term action on this, but I would urge investors into the helium and this marketplace to take a really close look at Mendell, because if you can pick up the stock now when the company's got a market cap of 1.67 million, I think this is going to explode into life once that deal is completed at the end of June. And that's just from the Roswell. There are a further 25 other wells, and it's going to be a transformational moment for the company once that well comes into production. And of course, going forward, the sky really is the limit.
I agree, Alan. I do like Mendell Helium quite a lot, just because it's a very simple business case and also getting into cash flow. And actually, Mendell are going to be featuring on the Stockbox Premiere towards the end of this month. I think it's around the 27th. Yeah, so 27th we've got Nostraterra coming on, Kazira Global and Mendell, all companies who are pretty much in cash flow, if not nearly there. And I think when you say about buying it and sort of putting it away, I think that's probably a good idea. The special feature I did with Nick, he explained a lot of how things work over there, and that Hugoton Field is sort of your pension pots, your pension funds, and they sort of sell it in eighths, so they're also locally funded, so you can buy an eighth of a well. And he told me that doctors and dentists tend to do that sort of thing, sort of put it away for like their retirement, or indeed to sort of pass it down to generations, because they can run for like 30-40 years, these wells, producing predictable revenue streams. So I'm actually quite tempted to, if I ever could afford it, to do something like that myself, buy an eighth of a well or something, and maybe Nick can help facilitate that. But if you can't do that, buy some shares maybe in Mendell and let them do it for you effectively, for a company that is, maybe it's not recognized because there's not many helium companies, or it's just not on people's radar at the moment, or they need to actually do the first, if you like, the first well and get that revenue coming in before people will recognize it. But from what Nick is saying, and from what the activity that is going on, it's quite clear to me that they're going to have steady revenue coming in and just build on that. So if you can pick it up now, and it wasn't long ago, it was actually under 1 million, I think. It's about 800,000 market cap. So it's nice to see it get above 1 million. But even at this point, I'd say that's still pretty good value for what they can get into over there. So I like it, and I like what Nick is doing.
Well, I think also another consideration too is, of course, the company was able to raise money very easily, raise another 800,000 a month or so ago, and that's the company has cash to undertake all of the development work and complete everything it needs to do, and that to raise that money in this market is no mean achievement, and that's obviously I think due to the fact that, as you say, there's plenty of opportunity over there. People are lining up over there to take part and to participate and to invest. But they raised 834,000, and of course, that money's gone straight back into the ground. Of course, Mendell have also supplied another 490,000 to M3 Helium to continue with the with the development there. So they've loaned them $1 million, and they're receiving 6% back on that as well. So whether they'll have that cash repaid or whether they'll convert that into shares, who knows? But either way, I know Nick will be on top of that. But yeah, a very exciting opportunity, and I think one that's going to literally explode into life probably within the next few months, and certainly once the transaction is completed at the end of June.
Yeah, that's not a long away at all, is it? So not long to see what's going to happen then. Okay, excellent. Thank you, Alan, for that. So let's talk about On the Beach then. We've spoken about them before, but what's the latest?
So On the Beach they're of course, it was only a few years ago we had the likes of Thomas Cook, the massive holiday operator, which carried a shed load of debt, and prior to its demise, provided actually a great day trading opportunity for people to buy and sell, because it was up and down all over the place. But I think in terms of holidays going forward, everything is done online, and it's a question really of the most efficient and the quickest app to get you to where you want to go. I mean, we've all seen the way apps like Booking.com and also Airbnb have developed, and On the Beach have got a very intuitive, simple process to complete the booking of your holiday. So they're already one of the UK's largest online holiday package specialists. They have a very low cost base with a high value customer proposition. They initially challenged the legacy tour operators, and of course, while Thomas Cook was going bust, On the Beach was taking market share hand over fist, but also providing opportunities for local online agents, because of course you'll walk down your high street and you might still see one of the old travel agents there, and of course there's an opportunity for the travel agents to work directly with On the Beach. The company's asset light. It's very profitable, and of course most recently the erstwhile Paddy McGuinness was their big advertising character for the ad campaign the company ran earlier in the year. So the company's run by Chief Executive Sean Morton. He's CEO. He joined as FD, and also he dealt with the Thomas Cook failure, which was pretty significant. The founder and non-exec director Simon Cooper. Simon Cooper founded On the Beach in 2004, listed the company in 2015, and it was literally founded in his bedroom at home. So he's got a history of developing online packages and businesses. He also founded On the Beach Travel in 1996, and that was purchased by Thomson's in 2008. So a very sort of capable guy. So the company has literally just announced a very strong set of interim results. This is up to March 31st. And in terms of its metrics, the company works with TTV, or total transaction value of holidays. During the interim period to March, that's basically October to March, the total TTV values, total transaction values, rose by 13% to 640 million. From that, the company takes revenues of 64.2 million. So the revenues were up 7% on the previous period, and adjusted pre-tax profits over that period also rose 23% to 7.6 million, and that was after the company invested $1.5 million into launching its offer in Ireland, which has gone very well indeed. Booking volumes over the period up 11%, well ahead of the package holiday market in general. EBITDA up 19% to 12 million, and that's reflects margin improvement all the way through, and also general operational leverage. Now, the company did have debt last time of nearly 47 million. It's reduced that by 18 million to 29.5 million. And that's after it has also paid a dividend out and also returned 30 million to shareholders via a share buyback scheme, which is currently running. Also, the interim dividend is up 11% to 1p as well. So year-to-date momentum is building nicely. Summer 2025, total transaction value is up 14%. So the rate of growth is increasing, and it has also launched a new 130 cities initiative alongside the Ireland launch, and the company is very confident that that's going to continue to drive growth and to accelerate growth. They're confident in the full year consensus of adjusted pre-tax profits of 38.5 million, with medium-term ambition to get to total transactions of 2.5 billion, 100 million of EBITDA, and 85 million pre-tax profits. So that's pretty ambitious, but given the way the growth seems to be accelerating, I don't think that's an unrealistic target at all. Of the share buyback scheme will continue. They've targeted 25 million, and that there's together with a strong trading momentum, they look well placed to pay down that debt as well. And I think once they get to that point where that debt's cleared off, then you're going to really start to see the company accelerate. Good share price performance over the year. The company's trading currently at 252p, been as low as 127p, but shares are now building nicely. If you look at the momentum over 2024, 25, it's been a strong upward momentum all the way. And I think we were at highs of 410p back in 2021. So I would expect, given the momentum, we are sort of on the way back there. So yeah.
Good. So since we last spoke, then you feel they're in a much better position than what they were. I think, considering that a lot of debt's been paid off, that's obviously a good thing, isn't it, to shore up the balance sheet a bit more?
Yeah, well, I think also hiring Paddy McGuinness, for their ad campaign, that really signals a lot of confidence out there to the market. Where Paddy says stop booking around. Obviously, the sort of a snub at or sticking two fingers up to Booking.com, but that's obviously worked well. It's the advertising has paid off and it's delivered this growth. But I think with these other initiatives, once that debt's paid down and these other initiatives kick in, then I think we're going to see this company's growth continue to accelerate. We've already seen we're seeing an improvement in total transaction value, up 14% on this year. Total transaction value, of course, up 13% on the last 6 months. So if it's increasing 14, 15, 16%, then that's pretty exciting stuff. And also, of course, it pays a dividend too. So, and a good offering all round.
Excellent. Good. Well, thank you very much for your time, as always, and we can speak in a week's time.
Thanks, Mark.
Pleasure, Mark. Yeah, speak next week.
If you enjoyed this interview, then give us a thumbs up, a like, or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.